The future of insurance pricing, is it an art? Is it a science? Or is it something different? Today we're going to find out. In today's FintechOS Evolv podcast, I've got two super guests. Both podcasters, both authors in the pricing world. I've got Jeremy and Catrin. Pleased to meet you guys.
Hello, Scott. Pleased to be on the show.
So great to be here.
Great. So we've got about 45 minutes, and I've been told to shut up on these things because I talk too much. So I'm going to try and get as much out, because you guys are the experts, so I'm going to try and get as much out of you as I can in today's session. So just to set the scene, I think what I'd like to open up is, like, I've been doing insurance for, 35 years, came into the Lloyd's Syndicate when I was a youngster, and I met my great mate who you know, Steve Dunn, who taught me everything I know, which is good because he's a super guy. And I've continued on in the pricing world through many, many jobs. And when I started, things were very basic. We started off in the SaaS world doing pricing with the Proc Gen mod. And then fast forward 25 years, I'm still seeing that code still being developed, still being used. So I know there's a lot of technology come through, and we can talk about it. The things like the Ernixes and the emblems and the radars and the quanties. But you're the experts. Could I just have a brief summary of where you think pricing has come from and where it is today, both in the personal lines world and the London markets?
In personal lines, obviously, it's a very fast-moving space, and I think most personal lines insurers now have moved totally from GLMs, generalized linear models, to machine learning type models, maybe bar a few smaller perils. So they've definitely moved methodologies, which obviously comes with moving their tech stack as well. In the commercial and London market space, I think that transition is still largely to come, although some of the slightly bigger players are starting to move, although it's obviously a lot more tricky when you've got that much more heterogeneous product and risks that you're writing.
I think it's an interesting question to say, is it an art?
You can tell me it's the wrong
science?
question. I've got no problem with that.
Do you know, I kind of think it is a slightly different question. So I can see how there's a mixture of art and science about it, but I think that's lower down in my mind than whether it's fiction or non-fiction. So when I first came into pricing, which is kind of around 2009, I would say it was mostly fiction then. So rates were made up by people. There wasn't science behind it. There wasn't analytics behind it. And throughout my career, it's been the pushing of the non-fiction side. So the idea that we actually take data, take information, take knowledge and make prices from it. And frankly, different areas of the market, be it London markets, Lloyd's, personal lines, different products inside of commercial lines and personal are all in different places along that journey, that frankly painful journey of not being fiction anymore and moving into a world where prices are non-fiction.
But Jeremy, the way I still see it, so I'm still, how can I put it? Just probably 4 or 5 years ago, I was one of the big tier 1 insurers. It was commercial lines. And these guys, we were trying to look at some rating structures. And this is only 4 or 5 years ago. They were still kicking out relativity tables with a macro from emblem into SAS. And I'm going, hold on a minute, guys. Why are we still doing this? And then I thought, has it moved on? And I used to have so many debates around GLMs versus non-GLMs, and everyone's going, but no. Personal lines, commercial lines, everything's linear. There is non-linear capability. And now what we're hearing is the GBMs and everything else is coming into play. So I still feel that the whole pricing world is still legacy to me. This is how I view it, unless you can tell me otherwise. And is there some super new, because all I'm seeing is there's new algorithms coming in. And the problem with the algorithms is I presume it needs more data and better data to make the risk more appealing.
Yes, definitely the more advanced your model, your modeling technique, the more data and the better quality data that you need. So for a GBM, you can't just use the same data as you would for a generalized linear model. It's not going to work. You need more data in the same way that you can get away with having less data if you've got an underwriter and someone who's really experienced guiding the pricing of that risk. So the more advanced your modeling method, the more data you're going to need.
So what type of new data structures are coming in? I mean, I know we can talk about IoT and all this, but is it more personal data? Is it better, wider and deeper claims data? Where's the data coming from?
I'd kind of answer that yes to all of those. I think there's all of that is useful data to have. So better quality data is a very important part of it. Better systems. Many people have moved in that world, though. I think a lot of people are in a world where you do collect decent quality policy and claims data, but that can still be enhanced by lots of external data, be it IoT, be it just more information about people that comes in from, say, information providers, geographic information and knowledge as well. So we are in a world now, again, where it's important to actually know about the products that we insure.
So if I was to make the assumption that legacy approach, GLM, 40, 50, 60 variables, gradient boosting is what's come into the market. Is it significantly wider?
I think to build a GBM, you would want to be ingesting at least 300 variables, if not more. They can take more for sure. The problem really, or the difference with a GBM really, is that it's almost like sculpture. So it's like Michelangelo's David, for example. He starts with a big block of marble. And it's the same with the GBM. You start with everything in it. And the algorithm just wants all of those features in, because each one of those probably will have some improvement on the predictive power. And then the skill then for pricing is to remove the things that are not David, to remove the variables that don't make sense or that are really strongly correlated with another one, or that you think there's too many, this is going to be too complicated to deploy and maintain. And so the modeler then, instead of adding things to the model, which is what we do for a GLM, is to start with nothing fitted in your model and add. That's more like, I guess, Rodin's The Thinker, I suppose, when you feel sculpting. With a GBM, it's more about self-control and restraint. And I think we really need to see more of that in pricing, instead of just throwing everything in the kitchen sink into your machine learning model because you can.
So really if you throw everything in and start taking away when you're sculpturing it, is this the art part of it? Or can we throw science at it and go, can you just tell me what I need to take away? And can you tell me what I need to keep, please?
I think that's mostly still science. I think the important part that's art is the things that we don't know. And that's not data science is not going to get rid of the things that we don't know, because a lot of the real skill in pricing is dealing with all the things where it's not possible to know. So the main example here would be, your current claims number is not where your claims are going to end up. Some lines have got very long term before the claims are settled. And that difference between what you currently know and what you need to deploy in the future, that's really where the art comes in. And that is still a very in-demand skill.
Or even, not even just on the claims development side of it, but we know that there are new cars coming out all of the time, new properties being built in new postcodes, for example. And the real question, obviously your model is backwards looking. It's like driving your car using the rear view mirror. And actually what we want to be doing is driving our car looking forwards. And so I think the science obviously is building the machine learning model and building whether it's a GLM or a GBM. And both of those can be right in different contexts. I really wouldn't want anyone to think that a GBM is almost an evolved version of a generalized linear model. That's not what it is. Both can be the right tool for the job at different times. But the art that underwriters have always been really good at, and perhaps over the past few years, as insurers have rushed to bring in more data scientists, more people who are backwards looking, more people who are really data nerds, what we've lost is the product knowledge to say, oh, we're bringing out a new type of car. That car is very similar to this car, or that car, I can access the electrics on that car if I just pop the headlight off. So that's going to be, I can nick that in 20 seconds or less. You know, that is the kind of knowledge that pricing really needs on top of your statistical model. And there's the art.
Okay, I get that, but I was always, given that I'm not a practicing pricing person, I was always under the assumption if we haven't got data, historical data, say on claims performance of electric cars, right, then it's hard to provide some risk. But then I thought, is that not the same as just having any variable that you haven't got enough data on? You then go in, you impute, don't you? So is that not the same? If I haven't got, if I'm trying to write risk for electric car that I've got no claims on, how do I price for it? Mm-hmm. Do I compare it? Do I impute it? How does it work? Is that approach still happening?
I think yes, and it's similar. So, and it depends on the approach. You use many things to get to the right answer. So it might be imputing. It might be thinking about, if we take a vehicle as an example, as Catrin did, having a new vehicle and thinking about what vehicles it's similar to, that's a great starting place. But we do need people with the knowledge about vehicles in our teams that can actually understand that and say which vehicles are which.
See, this is quite interesting, because what I'm seeing here is a move towards people's knowledge of product and maybe industry, as opposed to being able to write a bit of logic code to develop the model. Is that where you're seeing it go?
Yeah, I think that's right. I think we were in a world where everything was just product knowledge once, and there wasn't the science and the skill sets there. And I think we went very much over into the science. And I'm not saying that was wrong, but we kind of went very much over into that. And that's, yeah, like people are at different stages in that journey, but it's working. And now we're seeing that actually we do need that product knowledge again. So it's kind of looking for people with those skills and abilities to enter teams as well. I
know that some big insurers are really bulking out their product knowledge and creating insured object teams. So whether that is teams, cross-capable teams, so some pricing analysts, some data scientists, some petrol heads, and we need that in pricing, and creating these cross-functional teams and saying, you're going to just keep an eye on our insured objects. What is out there? What are we not writing? Where are our prices most uncertain? Do that legwork. And I know that some big insurers are swinging a lot more into product now, and I think that is going to be probably the biggest lever over the next 3 years of profitability, because the world is changing. It's changing a lot more quickly, and being able to do future forward pricing.
Don't give too much away, because that's going to be my last question. So
okay.
we need to say that. We need to say that one to the end.
All right.
So just moving on. What I'm also keen on is, given that we are technically, we're moving forward. We do get a lot of assistance now in the science world, and the data is increasing. And I know there's going to be difference here between London markets and commercial and personal, but do you see a bigger capability to write risk at an individual level rather than where I came from, which was a segment level? You would always tweak segments just to, if you're under overinsured in them, you'd look at them. But are we now moving into individual? Have we got the data to go specifically for individuals and what their behaviours are and what they want to buy? Are you seeing that?
We are. I'm going to say yes. I'm just going to say out and out, yes, we definitely see that in personal lines. You can segment to the point that it's you. We know it's you. But I think even in commercial, I think actually in commercial lines, it's almost more important to really know your one individual risk, because if the risks are so different, and these are big premiums, big risks. If you've got all your eggs in one basket, then you want to watch that blooming basket. So I think it's so important for particularly commercial insurers to get this right and to be able to segment risk in a really granular way.
Okay.
I think it's an interesting one with the personalisation question, and I agree with Catrin. Yes, we are moving towards more and more personalisation, but in a way, we're moving back towards more and more personalisation. In the past, people always talk about this era when your agent knew you and could take information in about you as a person or you as a business and things, and then some of that got lost. And actually, in a way, we're returning to that world, and that's a good thing. But I would also say that we should remember that personalisation does not mean we're not pooling everyone's risks together. We are still doing that. And I think that's a common misconception, this idea that we somehow do less pooling because people get individualised prices. What we're doing is making sure that the amount people pay in, which ultimately is to do with the capital that they use in the insurer, making sure that that is very accurately worked out. And that's really very fair for everyone. So people aren't paying more for someone else. They're not paying less and taking from other people. They are fairly paying their way and going into a pool where they then draw on to claim should they be unfortunate enough to suffer a claim. They also all get the same use of the insurer's functions like customer service and so on. So it's still pooled, but it's just individualised in the sense that people pay in the right amount for them.
So here's something for you to consider. I've never really got to the bottom of this, and I know you're going to have an answer for this one. So given that the world is more dynamic in pricing, we've all real-time dynamic pricing, all great. We've got increased volumes of data, which is good. The little agents, the robots of the world are beavering away, building fantastic models, whether good or bad, right? Where does this speed of building and speed of deployment, how is it managed? How is it deployed? And what are the regulators thinking about this lovely fast world that we're moving in? Because I've got a feeling there's got to be some bumps here. This can't go through that super smooth, given the rate we're changing. So a couple of questions there. One is around the speed and deployment. How is it managed? And secondly, where do you see the regulators looking?
Yeah, I think it's a big area that's changed. So I would say when I came into this, we were quite slow to deploy things, but we also had an awful lot of freedom actually. Whereas now things are much more strictly governed and monitored, but we actually are much faster at doing things. So it's an interesting change in that way. It's not that we've got less governed as we've got faster, which is what people often assume you would have. We've actually got much stricter governance and we're faster to do things. We often see insurers having proper project management in their pricing teams because these can be quite big changes with lots of moving parts and lots of things that must be got right. So the actual structure around delivering these things as a project is something that needs proper governance and structure and planning. That's something that's happened in that time. And actually, I think that's a really good thing. And I think regulators should recognise that that's better than it probably was back in the past. So I think, yes, things are faster, but yes, they are also much better governed and managed and planned out.
So what's the, I haven't looked at this for a long time, but given that there is the ability to deploy quicker, I presume any risk in pricing is only going to change if maybe your claims have changed or certain experiences have changed. So from a personal line, say motor or home, how often are they doing complete overhaul rate changes when we're talking about dynamic pricing?
I think we're moving away from that now.
Are we really? Go on, this is a good one then. What's the change?
I think we're moving away from a world where insurers do one holistic, all the prices are changing across all perils once a year, once every 2 years, which is where we were a couple of years ago. I think we're moving away from that. And the reason is because it's really inefficient, actually, for some perils. For example, if you're a motor insurer, windscreen is less than 3% of your burn cost. So, but it still takes the same amount of time for me to build a windscreen model, take it all through the governance process, then deploy it, as it does for me to do that with, a TPI, an injury model, which is 50% of my burn cost. So it's really inefficient to update the things that don't really matter, that maybe haven't moved on very much, at the expense of doing other things. You could be updating your accidental damage model twice as often, instead using the same resource. And in periods of high inflation, as we've seen, you really need to keep an eye on your car parts, and you want to be remodeling that very frequently. So I think we're really moving away from one big holistic refresh once a year and moving to a world where personal lines insurers are deploying, some are at once a week. I think the best ones are at 2 or 3 times a week,
really?
And hoping to get to daily. And I think that's where people are going. I think it's going to be about small incremental changes, and we're seeing an increasing amount of software to help you do that. It's all about the monitoring cycle.
Is that just for the large tier 1, tier 2s, or are we still seeing MGAs, brokers that have got delegated authority, whether it's net rated, are they also doing that as well?
Yeah, I would say yes.
I think it's a trend moving towards faster deployment. That is the overall trend, because the quicker you can react, whether you're right or wrong. If you're right, great, do more of that. If you're wrong and you've got your prices wrong for whatever reason, you're going to be quicker to fix it. So I see the real arms race. The arms race over the past 10 years in pricing has been more models, more data, more external variables you mentioned. Mm-hmm. And I think over the next few years, it's going to be more deployments, more monitoring, more quick wins.
Yeah, I think that's right. I think modelling has been the superstar for quite a long time, and actually I think analytics is coming back, and being quick at making changes is coming back.
I think that puts pricing teams in a slightly difficult position. It used to be when you were doing one big holistic pricing refresh, the pricing team would create all of these rates, would export them, usually to Excel, or relativity tables. That was a fun day. Someone would have to check them manually, and then you'd pass them over to your friendly deployment team who would take care of the rest, and you'd see the rates go live in about 3 months, and that was all lovely for you. But with the speed, this constant deployment, we're moving more towards constant deployment, and deployment that is integrated into your modelling platform. So instead of handing it off continually, it's now the pricing team who are effectively overseeing a lot of that deployment as well. And so the requirements in terms of skills and capability and awareness of the regulator, of wider governance and systems, and of business strategy is being pushed more and more onto our pricing teams. And our pricing teams need more training, more relevant training, certainly than the actuarial exams, I would say, to be able to do all of that. The pricing teams aren't modelling teams anymore. They can't be. They have to be holistic.
I can see this happening in the personal line space from a quote and bind right through to it's hosted platforms now for the modelling, like the Radar Lives type. I get that, and I can see. Is that still applicable in the London market's commercial world? Because what I'm still seeing is a lot of when we're building products, I see a lot of spreadsheets. I see a hell of a lot of spreadsheets, and I see a lot of rating structures. So is the hosted pricing models, are they also applicable to the commercial world, or is it still very, very manual?
I think what's great about commercial and London markets actually is that they haven't got the legacy of years of terrible spreadsheets. They don't feel tied necessarily to macros. If they've never had a statistical pricing model, and some syndicates have never had a statistical pricing model, they've always been underwriter led, then actually you can start, you've got a blank sheet, and you can really design something that is what is fit for purpose for now and the future, instead of the situation that personal lines have found themselves in, which is already tied to these contracts, these softwares, these legacy systems. How can we piecemeal adapt? London market has an amazing opportunity to create future forward systems.
Yeah, I think that's absolutely right. And I think it's also a case that people are always on a journey. And to be honest, when people end up with very long lead times to get things deployed, or dare I say the occasional mistake that comes in, that's when people turn around and say, oh, we need to kind of move away from this world of passing around spreadsheets and actually have structured, proper systems for dealing with these things.
Just moving on a little bit, but still relevant to this. We do need to, unfortunately or fortunately, I'll get crucified if I don't mention AI. Right? Do you see this whole process? We're all talking about agentic and AI and, you know, how much people do we need? Where's your view on, purely from a pricing, nothing else, just from a pricing capability of building models, deploying, embedding it into core systems? Where do you see AI involved, or do you think it's limited? Has it had its day, or have we just scratching the surface?
I think there's places where it's useful, particularly for coding. So people do use it for help with coding, and it's very good for that. We do also, a lot of us use it, dare I say, to tidy up things like our emails and our conversations, because that makes us better at communicating. Do I foresee a world where you ask an AI to create prices and expect them to be any good? I don't really, in the next few years, certainly not. So the problem there, and I alluded to it, a lot of good pricing is about what you actually do not know. And so I cannot give an AI training data on the thing that I already don't know.
Yeah.
So I need to answer those questions. And I think it will happily give you answers. And I'm sure some people might deploy them.
I think if we're moving away from the world of big holistic pricing refreshes, and I think we are, then we're only making small, quick wins each time, maybe a couple of times a week. And you've got your deployment system in a place where you can afford to take a bit of a punt, because if it's wrong, you'll fix it tomorrow and redeploy. I think AI can make pricing changes for you. For example, and I know actually some insurers are starting to do this already, have built systems that do this already, building crawlers that you say, look for the segments that we are pricing most differently to the market price, for example. And you can get them looking for those bubbles of difference. And then using AI, you could ask it to create a pricing proposal. And I really hope that there will be a day where you can say, look, this is the template of the pack we need to get it through our governance procedures. Can you fill out the pack while you're at it? Because that saves me a job in PowerPoint. And AI would be able to do all of that for you. But if it pushes people away from being decision makers, if it pushes pricing professionals to people who can sit back and are just overseeing and just saying yes to the machine instead of being really involved in their product, then I think that's the big warning for me. We've got to know our product. We've got to know our models. And at the point that AI starts making us lazy, it can definitely go and do all of that work for you. But pricing professionals still have the final say on what our rates are. But I do think if we take it away from the modeling and say, can AI help us be better product experts? So instead of, don't just do a job for you, but there's lots of stuff I would love to do that I just don't have time to do. For example, I would love to read all of the newspapers, all of the What Car magazines, Auto Car magazines, to find out everything about new cars, what's coming out, what is a fire risk, what's being improved, whose chassis is being improved, whatever. You can actually tell AI to do that. Go read all the papers today, find me which car is being nicked in Kent today. Like that kind of, I'm going to say, value plus. That's not part of our current core job, but it's going to make us a lot better. So I would say, don't just use AI to do your day job. You do your day job. Get AI to do the extra.
I remember actually about 10, slightly longer ago, about 12 years ago, we had this fabulous macro made for us that would automatically fit some models. It would fit a GLM based on some statistics or other, probably the chi-squared. And it would also output these fancy PowerPoint presentations for us. But we had to fill in the commentary boxes. And my boss at the time, I can remember this so clearly, was like, well, we've all still got work because we have to fill in the commentary boxes. And the funny thing is that we never actually used that macro because it wasn't very good at making a model. But it feels like now we have actually come up with the thing that will write the commentary for us. So that's kind of the world I feel like we live in.
So that's a lovely segue for me into, given that we've whether it's science, whether it's an art, whether it's both, whether it's changing, we're deploying quicker, we're building quicker, we've got more data, we've got more technology. I suppose what I'm thinking is, how does this have an impact from your world? How does this have an impact on the type of people that we actually need to run these pricing organizations? I presume, because you alluded to it earlier, I presume there's a change from in my early days where it was a pricing guy sitting down writing code. I presume the staffing levels, the mentalities changed, the type of people have changed. What's your thoughts? Where's it heading?
I think we've been on a long journey of change, actually. One of the things I always find funny is that people, so we're both actuaries, and people often say that actuaries stick to a very narrow area. It would be lovely if actuaries were really wanted in civil engineering and things like that, but we never seem to break through into it. Weirdly enough, I always think general insurance pricing is an area that's just not actuarial, where it used to be lots of actuaries' work. Because it's not. Actuarial is about payments, and when money comes in and out, it's about cash flows. That's what actuarial science is actually about, and that's what we spent sort of 15 exams and many years learning about. Yeah, I go and do general insurance pricing, which is really unrelated to what they taught me in my actuarial studies, as do most of the actuaries that work in general insurance pricing. So I think that's an area I've very much seen actuaries no longer being the king people in that area. Yeah. Absolutely not. And I think that's happening. It's happened very much in personal lines, happening in commercial. I think there's only the really extreme risks where there really isn't data, where actuarial cash flows are what's actually important. So I think that's an area that's quite interesting. So we've had sort of a flurry of data scientists come in. We've had people from IT and deployment backgrounds. And actually, I should say, I do think the IT deployment background will decline a bit now with the AI, because so much coding can be done, can be helped by the AI side. But I definitely think we're seeing more people that have product knowledge in now. So it's not like it's meant to be in the head of the underwriters anymore. It's like you actually have people in pricing who are knowledgeable about products. So I think that's the big area that's going to grow in skills.
And is that product knowledge adding to the risk? The models that are building, are they better risk models because of the products they know about? Is that how you're seeing it?
100%.
Yeah, definitely.
I definitely disagree with Jeremy, though. I think that this is absolutely actuarial work. Pricing general insurance, or pricing any kind of insurance, is actuarial work, because actuarial science is about quantifying risk. And this is exactly quantifying risk. So this is actuarial work. People are doing actuarial science. Are they qualified actuaries? Well, it doesn't matter. Whichever specific exams that the institute deems are the right ones to get a little gold star at the time. I mean, that's not really here or there. So there is definitely a space for better, more accessible and relevant training that people can do. And I think actually that's definitely needed in the pricing space now more than ever. But yes, it is actuarial work. It is actuarial science. And the product aspect of this means that we're not just relying on the computer. We can price future forward. We can look at what our price, we can adjust our pricing model so it's going to be relevant for the cars, the houses, the people, and the behavior of tomorrow instead of last year, 2 years ago. And I think the reason, or the big skill that people need for pricing, is an eye on profitability. And how does this change make me more profitable in the segment, and how does it work overall? So I think that real drive to make some money. Let's make some money. We're competitive people. So I think that's a really, really important skill that teams should try and have a bit more fun with.
I do agree it's actuarial science, but actuaries do not have a monopoly on actuarial science. And I think sometimes they think they do, and they really don't. It can be done by anyone that takes the time to learn actuarial science. You don't need to study 15 exams to be an actuary.
I'll give you one example on how product knowledge has helped me personally in one of my previous roles. Is I had a team and we were doing car insurance. And I set up a little mini game and I said, if anyone finds me a new way to steal a car, I'll buy you a hot drink of your choice, whether it's sort of all these fancy coffees you get now, whatever it is. I will, if you find me a new way to steal a car. And so every week I would get, some weeks we wouldn't find anything. And some weeks, a graduate would say, oh, I found it. If you pop the headlight on this specific type of vehicle, you can clip straight into the electrics. I'm in within 10 seconds. I never asked how they found out. We don't test this information, but someone would say, "Oh, I saw a TikTok video where you could do this." Someone would find me a BBC News article in a certain area of, Kent is always the problem area for car thefts because it's close to Europe. But they would find these things, and with that information, we could then price more appropriately for those specific vehicles. So we're not just talking about I'm not going to say car brand, but all of one type of car brand, or even all of one type of car brand and model. I'm talking about the models that came off the line between 2018 and 2022.
Yep.
And those ones we're going to price better.
Yep. And
we actually created a Blue Peter style, I don't even know what they're called. What are they called? A Blue Peter style totalizer, with the lights. You used to see them on TV. And we would, every time we made one of these changes, colour in the little totalizer. And by the end of the year, we were like, wow, we've actually saved over 7.5 million just on these tiny little changes. These changes that, again, are not big holistic pricing refreshes.
But the product knowledge is supporting it, isn't it?
And that's the product knowledge. And, one person saying this car is keyless, but it has an option not to be. Can we do something with that? That information saved us 1.8 million. And then someone else gets a bit competitive and goes, well, if he saved 1.8 million, I'm going to go and save 2.25 million. And we used to have this really fun, friendly competition, A
little bit of gamification in it.
Yes. And it's that kind of, can you see an opportunity? Yeah. But it all starts with, what are you insuring?
Can I just, we haven't got much left and I've still got a few more questions we might run over. Just changing gears slightly. So from a pricing point of view, where do you think organizations like us at FintechOS, who provide core platforms, whether it's quote to bind, whether it's a product build, whether it's digital journeys and claims, where do you think we need to support our insurers, our MGAs, our brokers, or appointed reps in terms of pricing? Because we build products and what we say is, give me your rates, give me your pricing, give me your API. Is that good enough, or do you think we need to step our game up and start doing something different to cater for everything we've discussed today?
I think the biggest thing that software companies need to build in now is governance. As we already mentioned earlier, the regulator is coming in heavy-handed on a lot of these things, and that trend is likely to continue. So the more governance that is built into software, whether it's about version control, whether it's some kind of checks against a list of features you can and can't do, whether it's forcing features to be monotonic or not, or something else, that I think is a big opportunity, because the quicker that can be done, again, that enables the quick deployments.
Yeah, I think there's really two important areas. So the first, and it's interesting because they sort of conflict. The first is that things should be end to end. So it shouldn't be multiple systems do lots of different pieces of work. So it's nice if data integrates properly. It's nice if you've got your MI in the same system. It's nice if you're not processing your data multiple times. It's good to take it all the way through to deployment. But there is one area that conflicts with that, which particularly things like Python and the open source for analytics, where I do want to be able to bring things like that into my pricing environment from outside.
Right, we're really coming to an end. I do want to have a little chat about your books in a minute, but before that, just a minute each. just tell me what's on the horizon. Are we staying still? Are we moving at a snail's pace, or are we ploughing through the pricing world? What's coming up? What have I got to look out for?
I think all areas will move to being more scientific. That's been the trend for 40 years since we first started seeing GLMs used and the people pioneered actually analysing data to come up with prices. So I think 45 years of science in pricing has been the absolute direction of travel, and I think that's the future. It will continue like that. Different areas of the market remain in different places along that journey, but if anyone's sat there being like, oh, my segment's going to stay fiction, they're wrong. It's not going to stay fiction. No area is going to stay fiction.
I think the future is cross-functional, product-focused teams, and I think particularly pricing professionals, but I think everyone across insurance should be really excited about that.
Price writers, just tell me who you are, what you do. Tell me about your books and where do I get them and who should I give them to? Jeremy, you've gone. Yeah.
Shall I actually wave my book?
You do what you like.
All right. So my book is Price Writer.
Yep.
So it's intentionally a non-technical book. So it's for anyone that wants to know about pricing, and particularly people that want to lead pricing teams, be they technical or non-technical individuals. You'll learn in 9 steps how to do that role and how to actually manage a team that's effective. There's lots of areas that will take you through data, deployment, governance we talked about, and it really helps someone become a successful pricing leader.
And are you personally going into tier 1, tier 2 insurers talking about this?
Yeah, I've been given several talks. We run annual conferences as well. So we have a large number of pricing directors come and join us from big firms, from a good range of firms actually, from the really big brand name insurers all the way to smaller MGAs and smaller products. It's not just for personal lines. We have all areas come and join us.
Price Writers is a training and education company specialising in general insurance pricing. We run workshops, online training and graduate schemes, as well as conferences. And our customers range from A all the way through to Z. I'm sure you can think of who that Z might be.
I know one.
That's Price Writers.
And the book, talk about your book.
And then I'll say something about Catrin's book as well.
My book is called A Risky Business, an Actuary's Guide to Quantifying and Managing Risk in Society. Don't be fooled, it is super fun, even though it's not a very colourful front. It's for anyone who works with, wants to be, or, and I'm very sorry for these people, lives with an actuary. So if you've ever thought, what do actuaries do? Like, what do you do all day? It's in here. And we have a chapter, you'll love this, a chapter called The Science of Pricing. And the following chapter is called The Art of Pricing. So this book is just for you. Yeah, it's really accessible. You can read it from GCSE up. So, and it's got loads of fun things across the whole suite of actuarial science.
And your book looks thicker than yours. I presume that's a better book. I'm going to read that one.
Do you know, interestingly enough, Catrin's is a more serious, can I say?
It's serious, but you know, it's really accessible. It's got Taylor Swift quotes in there, Dr. Seuss quotes. It's got lots of relevant examples. It's just that actuarial science is such a big... has such a broad range of things, and each of the chapters is just 10 pages. It's like a little buffet. You can pick and mix this book in any order you like, so don't need to read it cover to cover either.
My book's cheaper.
Guys, it's
if I could just say,
yeah, of course you can.
So my dad really wanted me to be an actuary. So he wasn't an actuary himself. He actually worked in the post stream at a life insurer, but he particularly wanted me to be an actuary. And he never really understood what it was, though. It was people that worked in offices and frankly got paid well. So I would have really liked to have been able to give him a copy of Catrin's book for him to read and understand the work that I do.
Very good. Guys, we'll come to an end. It's been an absolute pleasure. I've enjoyed it. I hope you have. I've learned a lot. So thank you so much. I will be looking at these books. So yeah, so I can learn more.
Thank you so much.
Thank you.
Thank you.